When it comes to investing, most people think that the key to success is finding the hottest trend or making bold, high stake moves. But here's the contrarian truth: wealth is built through small, consistent actions that compound over time. Imagine a tiny ant. It carries a fraction of its weight on one trip, but through relentless repetition, it moves mountains. That is the essence of true investing success. Here is the kicker: consistency isn't about the secret sauce, it's the ultimate superpower for creating generational wealth. And the best part, anyone can wield it if they commit to the process. Timeless investment principles affirm that this approach, whether it's Warren Buffett measured compounding, the strategy of family offices managing billions, or quiet discipline of top performing athletes, consistency beats chaotic, high risk strategies every time. And I've lived this truth. As the founder of Infinity Nine, I've built a global portfolio connecting international investors to US real estate opportunities, delivering annual returns exceeding 20% consistently. This wasn't achieved through luck. It was the result of meticulous planning, deliberate actions, and the discipline to stay on course. That is why I co founded the Henry Club and the Miami Family Office Club to create a platform for sharing these strategies and helping investors access exclusive opportunities. This is the kind of thinking that transforms financial legacies. If you ignore this principle, you risk financial chaos, chasing trends, reacting emotionally, and hoping for luck. But if you embrace it, you can achieve life changing security and independence. Let me tell you a personal story that drove this lesson home. Years ago, I survived a near fatal polo accident. In an instant, my life flashed before me. I realized how unpredictable life is, how little we control into storms. But I also learned that we can control the foundations we build. Consistency in investing is one of those foundations. It's not just a financial principle, it's a life principle. And one of my mentors once said, risk comes from not knowing, it comes from what you're doing. When you invest consistently, you reduce your risk and take control of your financial destiny. Let me take you into a deeper real life example. A client of ours, a 47-year-old physician, was overwhelmed by volatility of traditional markets. His portfolio scattered, stocks here and there, some bonds there, and no clear strategy. He was tired and of sleepless nights wondering how the next market swing could impact his retirement. Together, we created a plan grounded in consistency and alternatives. Over 5 years, his portfolio evolved into a diversified mix of cash flowing real estate syndications, private equity funds, and even a small debt allocation to debt instruments and to private credit. The results? One, his net worth increased by 35%, not through risky bets, but steady compounding. His portfolio became shock proof during market downturns. And three, most importantly, he gained peace of mind. His wealth was finally working for him. Let me paint even a clearer picture with numbers. Imagine starting with $1 million dollars in investable assets. A traditional portfolio might fluctuate between 5 and 8% returns depending on market conditions. But with consistent investment in alternatives, we've seen an average of 12 to 15% annually. Over a decade, that's the difference of between growing 1.7 million versus 3 million. That's the power of consistency and smart diversification. Let's address some common doubts. One, consistency takes too long. I want fast results. Think of it like planting a forest. You could chop down a few trees for quick firewood, or you could plant seeds to grow that into an ecosystem, providing for generations. The fast approach burns out while the consistent approach sustains for your life. Number two, what if you don't have the capital to start? Well, here's the truth. You don't need to be a millionaire to begin. Start where you are. Allocate a small percentage of your income each month into investments aligned to your goals. Small, consistent contributions compound into significant results. Three, what if the market crashes? This is where diversification and planning come in. Consistency doesn't mean blindly investing. It means sticking to the disciplined plan that accounts for risks. By incorporating alternatives like real estate, private equity, and debt instruments, you create a portfolio that weathers storms. Four, consistency is boring. I hear this a lot. Boring is good. Hey, as investors, our goal isn't to chase excitement. It's to achieve financial freedom. Think of consistency as a quiet engine that powers you toward your freedom, 1 mile at a time. Here's how you can implement this approach today. Number one, clarify your vision. Begin with your end goal. What does your financial freedom look like to you? Is it like a certain net worth, passive income, or leaving a legacy? Define it clearly so each investment decision aligns with that vision. Number two, automate your investments. Automation eliminates emotional decision making. For instance, you can set up monthly contributions to diversified funds or consistently allocate real estate syndications every quarter. Three, build a core of alternatives. Don't rely solely on traditional markets. Start incorporating private investments like debt funds, real estate, or venture capital. These assets provide stability and growth beyond the volatility of stocks. Number four, and the most important, seek expert advice. Don't go it alone. Partner with advisors or groups like family office clubs that specialize in consistent wealth building strategies. Remember, expertise accelerates results. Five, measure progress quarterly. Consistency isn't about rigidity, it's about adaptability. Set aside time every 3 months to evaluate your portfolio, adjust allocations, and ensure you're still aligned with your long-term goals. This approach isn't new. Some of the greatest investors, Warren Buffett, Ray Dalio, and even family office managing billions, have embraced the principle of consistency. Buffett once said, "The stock market is designed to transfer money from the active to the patient." Patience and consistency go hand in hand. And if you think this is only for billionaires, think again. The average investor can achieve remarkable results by applying these same principles on a smaller scale. Consistency is the unsung hero of investing. It's not flashy, it's not dramatic, but it's the foundation of true wealth. If this resonates with you, I've prepared a free guide of alternative investments to help you get started. It's packed with insights into building consistent portfolio that grows, protects, and provides. And don't forget to tune in next week and we'll uncover why real estate beyond rentals might be your ultimate wealth building tool. Remember, wealth isn't about making bold moves. It's about making intentional, consistent decisions that lead to extraordinary outcomes.